Unraveling the Turmoil, Decoding the 2008 Financial Crisis. The 2008 financial crisis was a devastating event that rocked the global economy to its core. Originating from the United States, it quickly spread, affecting economies worldwide. This crisis led to the collapse of major financial institutions, skyrocketing unemployment rates, and widespread economic turmoil. Economic conditions leading up to 2008 were characterized by excessive borrowing and risk-taking by banks and financial institutions. Low interest rates and easy credit terms fueled an unsustainable increase in asset prices, particularly in the real estate sector, setting the stage for a financial catastrophe. The housing bubble, a significant contributor to the crisis, saw an unprecedented rise in property values. This boom was driven by speculative investment and a belief that prices would continue to climb indefinitely. However, when the bubble burst, it led to a sharp decline in housing prices, leaving many homeowners with mortgages that far exceeded the value of their homes. Subprime mortgages played a pivotal role in the crisis. These high-risk loans were offered to borrowers with poor credit histories, betting on the continuous rise in property values for profitability. When borrowers began defaulting on their loans, it triggered a chain reaction of financial failures. The fall of Lehman Brothers, a giant in the banking sector, marked the onset of the financial meltdown. Its bankruptcy sent shockwaves through the global financial system, illustrating the interconnectedness of modern finance and the domino effect that can occur when one major player collapses. As Lehman Brothers crumbled in September 2008, it marked the beginning of a global banking crisis. The fall of this financial giant sent shockwaves through the world's financial systems, highlighting the interconnectedness of global banks and the fragility of the financial ecosystem. The crisis quickly spread beyond the United States, affecting financial institutions worldwide. Banks in Europe and Asia faced unprecedented liquidity shortages, leading to government interventions and bailouts on a global scale. This period underscored the vulnerability of the international banking system to U.S. market dynamics. In response to the financial turmoil, governments worldwide implemented extensive bailout packages and fiscal policies aimed at stabilizing the banking sector. These measures, while controversial, were deemed necessary to prevent a total collapse of the global financial system and to restore confidence among investors and the general public. The role of credit rating agencies came under scrutiny during the crisis. Flawed evaluations and overly optimistic ratings of financial products, especially those tied to the real estate market, contributed to the severity of the situation. These agencies faced criticism for their part in misleading investors and exacerbating the crisis. The ripple effect of the financial meltdown was felt across the globe, impacting jobs, homes, and savings for ordinary people. The stock market crash that followed erased trillions of dollars in wealth, leaving millions to grapple with the consequences of a crisis they had little hand in creating. The auto industry bailout was a crucial step in preventing a total collapse of a key sector in the U.S. economy. Major manufacturers like General Motors and Chrysler faced bankruptcy, threatening millions of jobs. Government intervention provided the necessary lifeline, preserving a significant portion of the manufacturing workforce and indirectly supporting industries reliant on auto production. Quantitative easing emerged as the Federal Reserve's groundbreaking strategy to stabilize the floundering economy. By purchasing large amounts of government securities and other financial assets, the Fed injected liquidity into the banking system. This unconventional method aimed to lower interest rates and encourage borrowing and investment, laying the groundwork for economic recovery. The European debt crisis, a direct aftermath of the 2008 turmoil, underscored the interconnectedness of global economies. Countries like Greece, Italy, and Spain grappled with soaring debt levels, leading to austerity measures and financial bailouts. This phase highlighted the fragility of the European banking system and the need for stronger fiscal unity among EU nations. Recovery measures post-crisis have focused on tightening financial regulations and improving oversight. Efforts to bolster the economy included stress tests for banks, increased capital requirements, and initiatives to enhance transparency in financial transactions. These steps were designed to rebuild confidence in the financial system and avert future crises. the Dodd-Frank Act marked a significant legislative response to the financial crisis. Aimed at reforming Wall Street, the act increased government oversight of financial institutions and established consumer protections to prevent predatory lending practices. Despite its intentions, the act has faced criticism for potentially stifling economic growth and increasing regulatory burdens on smaller banks. The 2008 financial crisis sparked a wide range of criticisms and controversies, particularly regarding the effectiveness of the response measures. Critics argued that the bailout packages and fiscal policies benefited financial institutions at the expense of ordinary taxpayers, creating a moral hazard by rewarding risky behavior. The Dodd-Frank Act was introduced as a cornerstone legislation aimed at reforming Wall Street and protecting consumers. However, it faced scrutiny for potentially stifling economic growth due to its stringent regulations. This sparked a debate on the balance between financial stability and economic freedom. Personal stories from those directly affected by the crisis painted a vivid picture of its impact. Many individuals lost their jobs, homes, and savings, highlighting the human cost of the financial turmoil. These stories emphasize the need for more effective safeguards to prevent future crises. The role of Fannie Mae and Freddie Mac in the housing bubble became a focal point of criticism. Their push for homeownership among low- and middle-income Americans is believed to have contributed to the housing market's collapse, underscoring the complexities of government intervention in the economy. The AIG bailout was particularly contentious, raising questions about the implications of rescuing failing companies. The government's decision to save the insurance giant was seen by many as a clear case of moral hazard, sparking a debate on the principles of free market capitalism versus the necessity of government intervention in times of crisis. The 2008 financial crisis left small businesses in a precarious position, struggling to stay afloat amidst tightening credit markets. Entrepreneurs faced unprecedented challenges, with many unable to secure loans or lines of credit, leading to widespread layoffs and business closures. In the wake of the crisis, unemployment rates soared, hitting a peak not seen in decades. This surge in joblessness had long-term effects on economies worldwide, with many individuals facing difficulties in finding new employment and some sectors slow to recover. The global recession that ensued was deep and far-reaching, affecting economies at every level. Countries around the world fell into recession, with trade volumes shrinking and consumer spending plummeting, demonstrating the interconnectedness of modern financial systems. From the ashes of the crisis, lessons were learned about the fragility of financial markets and the importance of stringent regulation. Economists and policymakers alike have since emphasized the need for more robust financial oversight to prevent a similar catastrophe. Looking forward, the future of financial regulation remains a hotly debated topic. Ongoing reforms and discussions aim to strike a balance between fostering economic growth and preventing excessive risk-taking, ensuring the global financial system is both dynamic and resilient. The housing market today bears the scars and lessons from the 2008 crisis. Prices have slowly rebounded, but the regulatory landscape has significantly changed, aiming to prevent a similar catastrophe. Buyers now face stricter lending criteria, which has stabilized the market but also limited accessibility for some. The state of the economy reflects a robust recovery from the depths of the 2008 financial crisis, yet the journey has been uneven across sectors. Innovations in technology and a shift towards a more service-oriented economy have driven growth, though wage stagnation and inequality remain pressing challenges. Our documentary conclusion draws together the complex threads of the 2008 financial crisis, emphasizing the global interconnectivity that amplified its impact. It reflects on the resilience and adaptability of economies worldwide, while also acknowledging the profound personal and societal costs incurred. Calls to action urge viewers to deepen their understanding of financial systems and advocate for responsible economic policies. Educating oneself on financial literacy is presented as a crucial step towards empowering individuals to make informed decisions and contribute to a more stable economic future. Credits and acknowledgments give due thanks to the numerous contributors and sources that have enriched this documentary. Their insights and experiences have provided a comprehensive overview of the financial crisis, ensuring the narrative is both informative and grounded in real-world perspectives. Thanks for watching, and we hope we have provided a simple yet thorough, informative video about the 2008 financial crisis.